Excellent, fantastic. So welcome everybody to this webinar where we're going to be talking about the ocean freight market. I don't think I can come up with a more, let's say, exciting time and unprecedented times for this industry. So glad to see so many people logging on and joining. Clearly, it's highly relevant topic these days. I'm joined today by my good colleague Torsten. You want to say hi, Torsten?
Hello and happy new year. And I know that everyone is a bit frustrated about the last months and probably as well about the future, but I think we can give you some good insights in this webinar today and support your work.
Fully agree. Torsten, we're here for a good 30 minutes today. This webinar is recorded and we will distribute a copy afterwards. If you have any questions, don't be shy posting them in the question panel. And we will actually do our best to answer the question as we go along. So don't be shy, use that chat or question function and we will address your questions. There's already a couple of hundred people logged on, so we will do our absolute best to address all questions. Now, before we get started, we have one last housekeeping item this time around, which is different from all our previous webinars. We will run a survey, and like normal, webinars often have a survey afterwards asking a few questions about the topics discussed. That part stays the same, but we want to do something slightly different this year. The past 10 to 12 months has been very challenging for people all over the world, and a bit of kindness and generosity goes a long way. So all we're asking you is to complete a 60-second survey. Every survey completed, Zeneta, we as a company will donate $5 to a charity on your behalf. Now, a quick understanding of the charity we've chosen. It's called Becky's Bathhouse. It provides a safe and clean space for women and children in the refugee camps in the Greek island of Lesbos. We've chosen this because this charity sits close to home for some of our colleagues at Zeneta, and the money Zeneta donates will go towards a hot shower, cup of tea, fruit, fresh fruit, and above all, a safe and humane environment for women and children. So please, all you got to do is click on the link that's shared in the chat, I believe, or scan the QR code and answer 8 questions. At the end of the webinar, we will pull up the number of responses and see how much Zeneta will donate on your behalf. Thank you. Without any further ado, Torsten, this is what we plan to cover today: a quick intro about what we do as a company, and then look at where are we now and what can the listeners and viewers expect of the market. Quickly, what we're going to be leaning on today in order to provide market intelligence and insights to this industry is the world's biggest pool of contracted ocean freight rates. Zeneta currently works with shippers representing more than 12 million TEUs of volume that they move. Then we have an additional base of forwarders. 8 of the top 10 global forwarders, as well as a handful of shipping lines are connected to Zeneta. We deliver this pool of data and market intel that primarily is used for these purposes, especially for the shipper side. It's all about monitoring the market, staying on top of market events and understanding the price movements on the industry. More specific areas where our customers extract value would be more on the analysis phase, where they can do peer benchmarking, volume segmentations, and so forth to really understand how do I stack up against peers and how do I perform in the market. Then there's this period of the year that's related to budget and planning, where the data is super valuable, and then specifically on the tender side to run, let's say, a data-driven, fact-based RFQ, setting targets and using the data to understand performance in the various areas of the world. Now, with that in mind, Torsten, I think we've wrapped up the quick intro, and we need to start looking at where we are now. And to begin, we thought it sort of valuable to give a little bit of context and then summary. On a high level, outbound rates from Far East is breaking all historical levels we've seen. Asia, Europe, we've seen rates of about $10,000, especially on the market high. We will look at this in the platform as well. On top of the reported rate levels, whether it's Trans-Pacific eastbound, Asia, Europe, or Asia, South America, there are additional surcharges applied in order to get capacity or equipment. So even the rates that sort of aggregate into the platform comes with these surcharges on top as well. We will look at how we present that as well. Now that we're closing in on Chinese New Year in February, we can also see that the usual blank sailings are not present, and an immediate sort of market relief prior to or post Chinese New Year seems less and less likely. Even industry experts and veterans that we talk with now seems to be thinking that H1 might be a squeeze for the entire period. I can see already that questions are being posed. There's some questions asking about specific trades, whether it's inbound to Mediterranean or US East Coast to Mediterranean or vice versa, India trades. Those are all available in our platform, and if we get time towards the end, we can explore a few different browsings of trades, but we will follow up specifically with the users that has any specific trades in mind as they're available in the platform. Moving on, in this overview here, we reported prior in our last webinar that users or customers seems to be reporting this constant state of firefighting, and we now see that more and more is sort of seeing the norm of rolled cargo being rolled multiple times and increased sailing times being the issues or the transit time, as it's all delayed by this short shipping of cargo. Then as the pandemic continues and we still sort of spend less on services and travel, volumes keeps on growing as well, and there seems to be strains on equipment and continues into 2021. And as I mentioned, and this is key, it's an historical strong sellers market at the moment, and we see that with an outlook for H1 in total. Torsten, anything to comment on this?
I can probably just refer to the question seconds, as there's one question if the capacity is less compared to last year on Asia to US and Asia to Europe, and it's the opposite. The capacity is more, but a lot of the volume which should have been shipped in Q2 is just moved to Q4. So there's an extraordinary strong volume out of Asia in Q4, which is related to the blank sailings and the first wave of the pandemic, which is now moved just instead of Q2, probably more in Q3 and 4. And therefore the volume growth is so strong that even you have additional capacity in the market, that it's difficult to get all this cargo shipped. Yeah,
good.
And probably everything, like you already said, we just picked one trade to explain this because the situation in the market is quite diverse. What you hear, what you see, what we get from the customers, and therefore we picked one example trade to explain how our data is used by our customers to really get a very good understanding about the different behaviors in the market, because there's for sure a different way how different companies are buying freight, and this will be quite obvious when you see our data.
Yeah, I think another important point to sort of add to this is all the congestions that we see around, whether it's UK ports, Australian ports, or whether it's US ports, especially West Coast, where a consequence of all these congestions is the increased turnaround time of the equipment, right? It takes longer to get the equipment on shore than emptied and back into a loop where the carriers makes money on it. So that's one of the things that sort of it's one of the consequences that makes the equipment shortage worse than what it could have been if we didn't have these congestions.
Correct, and this will be, for example, as well quite interesting to see if the carriers will squeeze a bit more on detention demurrage later on this year. Probably most of you don't know it yet, but we have this kind of information as well, which we can share as this is part of the tender. And it will be interesting to see if new agreements, which will happen in 2021, if they see a reduced number of free time in order to increase the turnaround time of the carriers. Yeah, this will be visible as well within the tender. At the moment, I have no clue if this is already happening or not. I haven't heard anything, but throughout the year, it might happen that instead of 14 days combined, you only get 10 days whatsoever, because we have the data, which is really agreed for a long-term contract, and we can make this available on a global scale.
Yeah. Excellent. We're getting more and more questions posed here, specifically around the rate movement. So what I suggest, Torsten, is that we actually go into the platform and have a look at some of that. And today we wanted to give some historical perspective before we talk about where we're currently at. And the example that we're going to be looking at is China main ports to North Europe main ports. What we're looking at here in the graph is the market development, the market average for the short-term market since the beginning of 2016 until summer 2017. And there is a reason why we've chosen this period, and we're going to, of course, move to more recent numbers. But what we wanted to highlight here is that in March 16, on this trade, you had a market collapsing and the average reached $400 US. If I hit the lower end of the market, there was a 2.5 percentile point function here at 156. So the spread of the market from the low to the average was from 156 US dollars to 403. It was more or less for free to bring a 40-footer from one end of the world to the other one. And what we experienced here is that by end of August, the market had recovered some, but at that point, Hanjin collapsed. And the only consequence to that event was that the market went from 1,396 US dollars, peaking in September at 1,800. And since then, you can see that it sort of remained at that level until summer 2017. Now, if we include this, sorry, go, Torsten.
Patrick, just to make sure, the price, what you do see over here in the graph is the ocean freight rate, including all surcharges, bunker, PSS, whatsoever, but subject to THC both sides. As usually on this trade, the THC is quoted separately. Yeah, just to make sure that you do understand it correctly what we show.
Fantastic. And again, for a 40-foot standard dry box. Now, if we include this perspective and sort of roll all the way up until today, what we look at is a chart like this. So all the way to the left now, you will find March 2016, where the average was at 400 US dollars. And to the far right, you will find the market average of today. If I can hit this date, it's a bit tight when it's such a long timeline, but here you can see a market average value of 8,300 US dollars. I'm just going to scroll a little bit down to highlight the percentage increase here. Over these, what is it, 5 years here, 5 years, there is an increase of 2,000%, right? So the 400 goes to 8,003. And if I include the high and the low of the market, you will see a spread that has gone from a normal range of, let's say, 1,000 US dollars or so, exploding now from 6 to 6 to I think 11,295 US dollars on the short-term market. So what's really happened here, Torsten? Maybe I can zoom in immediately on this period. Let's only look at the last 12 months. Here you have that overview. Can you give some context to this?
I mean, I believe everyone who is active on this trade is fully aware of this kind of a scenario, because what people shouldn't forget, I mean, the long-term contracts, what have been agreed last year, they're still valid. Yeah, there's no question about it. I believe probably some were broken, but the feedback we get from our customers is quite clear that the past performance is still honored with tender rates. But each and every box you would like to move on top, or each and every pool pair which is not covered by any tender lane, this is now going to this kind of market levels. Yeah, where you really need to pay prices which are somehow in the range of 6,000 to 11,000 in order to get your cargo moved, if you are still able to. Because some carriers even announced late December that prior Chinese New Year will be difficult to accept any additional bookings. Yeah, and it was just overwhelmed with this kind of bookings they have received, and on top of this was the equipment shortage, because what has happened in Asia as well is that a lot of the bookings were made on the Trans-Pacific, because you get more money on the Trans-Pacific in September than you did on the Asia-Europe. Yeah, so this whole kind of positioning your equipment or put the boxes where you get the highest yield, this infected as well all the other trades. And this kind of view, what we do have on Asia to Europe, the same is valid if you check Asia to Latin America, if you check all the other trades. Yeah? This is visible everywhere. Yeah, it's just out of China, regardless where you're going, where you have this kind of massive increase.
Yeah, and I think it's worthwhile then highlighting one of the questions here that came in on government intervention, and since Trans-Pacific eastbound into US was the one that sort of started its uptake first, and since those two nations have a very sort of dependent relationship on each other when it comes to trade, immediately when those rates started to spike, the Chinese authorities and the US authorities started announcing a keen interest on the trade, and said that they would keep an eye on it, and anticipated that the carriers would cap their increases and keep it sub 4,000. What's interesting, and what I want to highlight here, is that we have since seen Chinese authorities mentioning that they are looking into initiatives that could bring some relief to this industry, because clearly this is not ideal for Chinese trade, having rates skyrocketing as it has outbound of Asia. And then next to that, there is concerns from, for instance, the the European Shippers Association about the development of this, because what we can see is that, if I look at the data here, is that also the long-term market is starting to follow suit here. We can now start to see substantial uptakes on the rate levels on the contract market. In fact, if I compare this to last year, we're looking at on average 150% increase here at the moment. But a lot of these rates now are what we call timey over rates. So there are shippers now playing with the existing rates they have, taking on some additional fees in order to negotiate slightly longer validity durations, in a hope that they can get over to calmer waters come let's say Q2, end of Q2, or even Q3. On top of that, what we also see is that a lot of shippers, and Torsten, you will know a lot about this topic as well, a lot of shippers has pushed through their tenders quite a big chunk of big volume players, and we now see a bigger spread in the market, in the contract market. So what I'm highlighting here is the market average and market low on long-term contracts. And you can clearly now see, Torsten, you want to comment?
I mean, it's referring to a question what we just got, that the contract expires May 1st, and if they should go to tender or not. Yeah, and it's extremely right what you do see, and I can only recommend to go to tender, because what we have seen was companies going not to tender were not able to agree new prices when the old prices expired in December. They are more or less close to the spot market with all the volumes they're moving. but the ones who are pushing forward with the tender, they were also able to achieve quite good rates, but it depends a bit how you define this one. For sure, on certain trades, you will see an increased level of 30 to 50%, sometimes probably even more. It depends a bit. It depends a bit on your supplier strategy. Do you work with carriers directly? Do you work with freight forwarders as well? How much are the suppliers interested in your volume? How stable is your volume flow? I believe it has never been as important as it is now to predict the volumes as precise as you can. Because in this kind of market circumstances, if you award a carrier or a supplier 5 boxes a week and you will only bring 3 boxes a week, I bet that from one week to another, they will cut your allocation to 3 boxes only, and the remaining one, which might turn up 4 weeks later that you move 7, yeah, they will charge you on top. This is something what we do see. And some people, if you show again the market low and kick out the market average on short, some people might be surprised that on the market low long term, we do not see this big of an uptake. Yeah, and it really happened. This is what we do see. Can you show it again, the market long, low?
Yep, absolutely.
And kick out the average on a short. We double check this number for sure with our customers as well. And people achieve these kind of rate levels. Just a few number, which are somehow close to this kind of rate, probably with suppliers, they are not able to move the same volumes like last year against this price, but these kind of rate levels are still achievable. And we see a big delta or a big difference between the prices quoted directly from carriers to BCOs and prices quoted from freight forwarders to their customers.
Yeah, and there's so many things to debate here and discuss, but let me add a couple of comments there. This, you can see the spread of this is unprecedented. We haven't had that historically, and that's another sort of strong indication that there's so much uncertainty in the market, and let's say suppliers behaving very differently towards different customers, and also a difference between what the forwarders, what you achieve going with forwarders or carriers direct, which also says something about your volumes in most cases, right? And then I can see questions coming in on whether they actually deliver on the long-term contracts, and we see that clearly they do, but they're way more sensitive to what Torsten mentioned when it comes to predictability and reliability. So the ones who accurately can forecast their volumes and deliver on that, those are the good clients that gets better service, to sort of simplify a bit. And to add to the question that you commented on, Torsten, on tendering, we recommend all shippers to have valid rates to book on, because it's such a difficult market. So whatever you do, make sure you have valid rates. You run out of that, you're going to be pushed onto the spot market, which we've seen here is a completely different level. And then we do not talk about like 30-40% cost increases, but we're talking about a transportation budget that goes through the roof. And final comment that I want to, sorry, Torsten, you want to say something before I toss in?
I mean, and this is probably one of the key messages for 2021. The budget, what you achieve on paper with your tender results, is not what you pay in reality, because I believe most of the companies will suffer as left and right new corridors pop up. Additional volumes pop up on lanes what you have agreed. So that means in reality, your transportation budget will be far higher than the one which you calculated in your tender, which was probably in a similar way valid for the past, but for sure not with the numbers we have seen or we see at the moment, where probably the spot market is 4 times higher than what you have contracted in the long term.
Yeah. What's almost, I want to raise this as well. What's almost incredible to witness is that the worse the entire thing is, you know, the harder it is to get equipment, the less capacity that is available, or the less space you actually achieve or get, and less reliability it all is. The less reliable they are in their sailings, the more they charge their customers. That's sort of been the equation now for the last, let's say, 3-4 months in particular. And that's almost like a paradox to me, because if we treat our customers that way, they leave the door. And I sometimes wonder whether all the M&As and the historical rate levels that we started off looking at is coming back now, and to a certain degree penalizing the customers, because it's turned into such a seller's market.
Yes, and probably just let me refer to one of the questions where one person asked how EU Commission might interfere in here. Yeah, and everyone knows that there's this still kind of this block exemption rule that they can use for the alliance services, and I would be very surprised if there is not something going on from the European Union, that they will check this behavior of the market afterwards. But even more so will do the US, if I'm not mistaken, because they're quite fast on this one as well. And it might very well be that something is going on here and that we see something later. But on the short notice, I would be very surprised if something will be announced.
Yeah, let me, I mean, there are questions pouring in here, so I want to be a little bit cautious about time as well. We will do our best to follow up afterwards. And just to be very clear, with our customers, we always, of course, go into their specific trades. We go more in depth. We showcase more trade lanes. So wanted to comment with that in mind on one of the questions about whether carriers live up to their long-term contracts and deliver on them, and whether long-term contracts will be broken when prices turn around and go down. And to that, I want to comment that I see that as part of the historical problem for this industry, that it's been, depending on whether it's a seller's or a buyer's market, the players, the buyers and the sellers, have been sort of illoyal to each other, right? And I see the temptation of, let's say, a downfalling market where you go and book with another carrier on the short-term market, because the financial difference delta is so big and attractive, and you might have an internal pressure as well from stakeholders around the business globally that might be quoted these lower spot market rates in that kind of market. And that's where I see a lot of the problems historically, and also to today's market, where you have the opposite situation, where carriers really have a strong incentive to push as much volume they can over on a short-term market, and adjust those MQCs as best as they can with their customers, so that they can win more and make better profits.
Correct. And this is probably really a key message as well. I would be very surprised if the perfect ship scenario planning of a carrier will look similar like 2020. I guess they would like to reduce the long-term market share at the moment on their vessels on some major trades, and to act more on the spot market with this kind of rate levels. So therefore, it might be that when you use one carrier for a lane in the past, that you need to split it now to 3, because the carrier from the past doesn't really accept the rate levels which you asked for now. So they reduce the capacity offered by 1/3 whatsoever. Yeah, because this is what we do see as well, that customers do need to nominate more suppliers for the same volumes than they have done in the past.
Cool.
So I believe we need to hurry on.
Yeah, we need to move on. As a sort of one final comment, we wanted to quickly just show that it's not all corridors that has this trade price movement. Here's an example of transatlantic westbound, where you can see the development of a 40-foot rate, which sort of trended downwards going into 2020 and continued all the way until summer here, before recently we've seen an uptake and a long-term market that's also slowly been moving upwards. And we urge our customers and new customers that's going to join us to keep an eye on these other corridors, because there might be ripple effects going into these now, and where we can see substantial potential rate uptakes on those as well. That being said, if you have this corridor for now, you can plan very differently than what you do on outbound Far East. Any final comment, Torsten, before we wrap this up?
No, I mean, just what we have heard, but that's quite unusual for this kind of corridor. Volumes are picking up, probably change a bit the booking behavior on Europe, US or Canada, be a bit earlier, because the ships are filling up as well on this one. Yeah, be a bit cautious for the supply chain.
Yep. Let us with nothing further to add, because we're running out of time. We wanted to make sure that we showed you guys how much we're going to donate on behalf of each of you to Becky's Bathhouse. Make sure to grab that link or scan that QR code and fill out the survey, please. It's for a good cause as well, and we will see what it accumulates to. While we're waiting for that and for this to play out, Torsten, any responses from our side as to whether we expect rates to return back to, let's say, a 2,000-3,000 level in Q2 2021?
Just opens the same question.
Yeah.
Very good one. If you ask me honestly, I don't think so. Especially as the tender season is still ongoing. Carriers will put high pressure on the prices in order to achieve the higher long-term agreements, because on the TP and a lot of business which is linked to the TP will be agreed only in March and April. The earliest, what I believe, could be H2, and that's really the absolute importance in our data on spot market as well. You will see it immediately, because usually what happens is that the spot market is not as strong on the high side. We have the high prices as well. As soon as the high market is softening, you can expect that the big peak is somehow over, and sooner or later the price or the rates will go down. And we show this kind of view on each and every trade, so that you have a very good overview, that you do have an early alert. Okay, something is going on. You can connect this with your operational experience, because you do see that probably you get easier space, you get easier equipment. Yeah, this is all linked together, but honestly, Q2 is probably slightly too early. But we'll see, because what we have seen as well and read and heard from customers, shippers have more warehouse capacity in China to store their cargo instead of shipping it, because partly they don't get space, and the other thing is they just can't afford 8K for the commodity they're shipping. So this is something what we do see as well, and we keep a close eye on this one to monitor this one, but a bit unlikely, I believe.
Yeah, I also want to add that since we got a question on that and since this ticker is still running, and I'm super happy for that. Thank you everybody for contributing. There's a question about whether we expect countries to close down for COVID-19 and that demand will decrease since there is no stock to fill. And I think that I would say that in 2020 we learned that COVID can really increase the volumes and our spending on durable and non-durable goods and such in that way, surprisingly, actually, for a lot of people, relative to what one would think in February, it put a real strain on the industry and sort of created the foundation for the carriers to create this market condition. And I would say that the interesting thing to follow here is going to be whether the vaccines is going to bring a relief closing in on summer, so that more consumption will be shifted towards services and travel again, and that could bring help bring relief. And Torsten?
Correct. I mean, there's a last interesting question, probably what we can still answer. In the future, will shippers, BCOs, be willing to pay in advance for guaranteed shipment of capacity, similar to buying an airline ticket? I mean, good question. If you get 100% acceptance of the cargo, it won't be rolled. You get it shipped. Probably there are certain customers who are willing to do so. Yeah. It's all about the innovation part as well. It's all about supply chain security. It might be, but in reality, what I have heard at the moment is, I mean, the whole industry is a bit weird at the moment. Yeah, you pay sky-high prices and the service is going to shit. Yeah, and this is something where you really need to be cautious. I believe, yes, there are customers out there. For these, it might work, but if this will work in general, I'm a bit, I'm not sure. Yeah.
Torsten, we could go on for hours, and this audience
Yes.
has been fantastic. We will, as a company, try to follow up on these questions. Thanks a lot for contributing, and keep on going with this donation. As you can see, already 125 of you have filled it in, and we're donating $5 on behalf of everybody who continues doing it. So please keep it up, and thanks again for joining this webinar. Again, it's instrumental to have this market data available now, as the market will continue to be volatile and difficult to maneuver. We will provide the power of our network and the data to help all our customers and dive deeper into all types of analysis there. Thanks again for listening and for joining us, Torsten, as well. Thank you.
Speak soon. Bye-bye.